Um, oh, wow. Um, Hi everyone. Good afternoon. My name is Maria Wiedner, and I am the CEO and founder of Cambridge Finance. I hope you're here to hear a little bit about financial modeling and in real estate, in property, and how we use Excel in order to do that. Okay. Normally, in times of AI, a lot of people thinking, oh, we're gonna bypass Excel and financial modeling altogether. Maybe we will. We're not there yet. So if you're still using Excel like me, we still might have another year to go, but we need to scale up on AI pretty quickly. But in the meantime, we do need to use Excel, especially because Excel is a way for us to deal with specific assets. They're not as standardized as most of our projects are. Okay, so let's get started then. I'm gonna start sharing here my screen, and hopefully it goes to our presentation. It's a great start here, isn't it? Building unbeatable financial models. Okay, so I'm gonna start here our presentation. Let me just swap presenters here. Oh. Okay, so it is called Advanced Financial Modeling Techniques for Real Estate, building unbeatable financial models for strategic real estate decisions, which is pretty much what I do for a living. So I do a lot of financial models in Excel because my assets are all bespoke. There is not one that is the same as the previous one. Of course, we use the templates that we have built over the years, but we still have to be flexible enough, and then we'll still have to understand where the numbers are coming from, so then we can make decisions, or we can advise, as in our case, decision makers on the best course of action. Okay. So one thing I would like to, so I'm just reading here. After mastering the basics, what truly sets great modelers apart is how clear, dynamic, and decision ready their spreadsheets are. So absolutely, I see a lot of spreadsheets from developers, from agents, from investors, from funds, from a lot of people. And absolutely, I think like the ones that are really good financial models are the ones that are very clear. They're ones that, as I call, beautiful and elegant. Because if there's very much, if it's like too complex, so much going on, you will know that it was probably done in a rushed way, or it was a template that somebody started using that downloaded from the internet and doesn't know really where the numbers are coming from or going to, just left stale numbers there. So we need to make sure that our financial models are as crispy clear as they can be. Okay. And they need to be every time I'm looking for financial models and financial modelers as well, we need to look at cash flow, like how transparent they are. So if the formulas are too complex, like if you know that nowadays a lot of people are copying from AI, and then the formulas are just like horrendous because they are so big, then you need to make sure that your formulas are transparent, and then you know what the numbers are doing, where they're coming from. Okay. Building dynamic rent roll links that automatically update income streams. So that's obvious now. But we need to, like nowadays it's easier and easier for you to get AI just to download from the tenancy schedule, or for you to replicate some kind of like a rent rolls on the spreadsheet. Okay, so make it dynamic, I think, is the main challenge. But I'm gonna show you today like how at least you're gonna do a dynamic scenario analysis. run sensitivity analysis as well. But today, what we're going to do is not only run sensitivity analysis, because that's, like everybody has already talked a lot about it, including myself. But I also want to tell you how to do the scenario analysis. And the difference between sensitivity and scenario analysis is because you're going to have more variables to stress. So in sensitivity analysis, normally you have two variables to stress maximum. I really like sensitivity analysis because it does give you an indication of the most important variables that we should stress, like what is the impact on your returns. But what is important as well is like how other variables, they connect to each other. We don't talk so much about the correlations, but it's with the scenario analysis, you understand how the variables are correlated as well. Okay. Applying quick fixes that make your workflow smoother and faster. I wouldn't call it quick fix, but like check variables. So like if anything goes wrong, if your construction costs are not adding up to your budget, then it highlights, and then you are able to track it down and see where the numbers, like where the error is coming from. Maybe normally in my case is the division by zero. I always have this problem that sometimes something is divided by zero and it still gives us an error. Okay. Okay, so structuring cash flow models for maximum transparency and efficiency. This is one thing that is very, very, very important. If you have come to my classes, I'll make you swear by this, because this is the idea of separate out inputs and outputs. Okay, inputs, calculations, and outputs, because we should not put inputs in formulas. This is what we call hard coding, and we should never hard code. Okay, if there is also, I've audited a lot of spreadsheets out there, financial models from banks as well, and one source of error that is always there is this hard coding, like a loan to value of 80%, and it's just like 0.8 across the board. And then if you want to stress this, you can't. If it's not set in stone, that you not at all set in stone, that you're going to get a loan to value of 80%. So you need to make sure that this is not hard coded. Okay. Consistent formatting with a clear naming convention. So this is especially like in tabs, you need to make sure that your tabs are not like hugely, the names are not great and big, and then I wouldn't recommend you to put spaces in your names, because that can have it will be hard for you to link the spreadsheet names if you're going to use, for example, indirect functions. What else? Naming, and then also I see more and more people color coding tabs. I think now like the industry found out about color coding tabs, and never color code white, because of the if you highlight all the tabs and then they're gonna be white, and then you don't know, you can't see that, like you've selected all the sheets because they're appearing right, but it is confusing. So yeah, make sure that you understand the basic principles of color coding, how layout works, so then you don't make those mistakes. Error-proof structured. So yeah, the hard coding is the main problem. Data validation is a problem if you're dealing with data sets in Excel, because a typo can just throw off your whole analysis. So if you have one Italy and the other one is Italia, and then you don't think about the typos, then you will make your analysis may be wrong if you don't pick up those typos. Okay, and also the type of functions that you have. Sometimes even by using, for example, lookup functions, and you don't use the exact match, this can throw off your analysis as well, because the match is going to be an approximation, it's not going to be exact. So you need to make sure that you understand the concept of dealing with text when you do data analysis. Okay, but one thing I would like to mention is that it should be clear, elegant, beautiful, not messy, not something that appears that you've just downloaded from Excel somewhere. well structured, color coding beautiful. You understand how you name cells, you understand how you name tabs, and I think that will make a difference when you structuring not only cash flow but in general your spreadsheets for analysis, for investment, for finance in general. Okay. Um, Building dynamic rent rolls. I don't want to dwell so much on it because these things, if there's one thing that can get very complicated in when we're doing modeling in Excel, in Python, or any other language, is the scenarios of a rent roll, because there can be many scenarios. So sometimes you might have, and the more you want to add flexibility to your rent rolls, the more it's going to get complex your formulas. For example, if you have if rent rolls, they are like step up rents, retail step up rents, and then indexed every year. Or it might be just like fixed contracts for 20 years with 5-year review to market. Um, and it might be just annual indexation, or it might be fixed for the next 3 years, and then there's going to be another review in 6 years, and then there is an option to break after 6 years, for example. So all those what if analysis, which are not really what if analysis, but they are like options uh, or contractual clauses, if you want to put them all together in one single formula, because the idea is that when you're forecasting rents, the rent roll, you are forecasting how the contract is going to behave. Then all this, what if, like the if analysis. So if the the contract is for indexation, then you're gonna use the inflation, and sometimes even inflation might be CPI, sometimes it might be RPI. So one thing that I would like to mention, and I think this is one thing that I really stress when I teach, is that you need to simplify the logic. So if you simplify the logic and say, okay, I see the pattern. The pattern here is that this is just indexation, and then it's going to be increased every year by RPI. Fine, create one cash flow like this. If it is another if it is a cash flow for rent reviews after 5 years to markets, then create another cash flow and then link afterwards with what we call the live table. Okay. I think simplification, understanding patterns in the modeling side, I think that's the art, because if you don't understand and you just try to put everything in one single formula, you will gonna get really muddled up, and I don't want that to happen. Okay. So build dynamic rent rolls, but understand that you're building, you are forecasting, and you're forecasting the contract, the behavioral contracts, and this can get very complex. So the art, the beauty, the art of financial modeling is to simplify this pattern and how we're going to link those in a way that is robust and a way that is accurate. Okay. Uh, Running effective. So I'm going to show you how to do the scenario analysis here. When we do sensitivity analysis, I know a lot of people love sensitivity analysis, and they just want to put 100 tables of sensitivity analysis, which is the what if analysis. What happens if, interest rates go up by 1%? What's going to do to your returns? What happens if inflation goes up by 2%? What's going to do to your return? So this is the what if analysis, the sensitivity tables. And a lot of times people just were like, oh, what happens if I change the yield to 25 basis points, and then I'm going to change the yield and the growth and the rent and then this, and you create so many data tables, and then your spreadsheet will get very, very heavy, and you will lose the will to live. No, not that to that extent, but it does get very, very tedious once you reach the point of what we call no return, which is when your spreadsheet becomes very, very heavy. Okay. There are ways for you to, like not make your data tables calculate. So there's like partial calculation or manual calculation that helps, but it's not ideal. So what I would like to say is that you identify key drivers in your model. Okay. Be it normally we're looking at exit yields, but look at what is the purchase price, for example, capex, for example. So all this, and then make sure that you're a bit more strategic. You think about when you are setting up your data tables, because otherwise it does get your spreadsheet will get pretty heavy. Um, Presenting sites visually. So I think it is important. Like normally there are some standard ways to show, for example, sensitivity analysis. Everybody likes to see the traffic light, yeah, the table. So the red and the yellows and the green. So if you understand that, and if that should help you when you're presenting your outputs, like with your investment recommendation. Um, Applying quick fixes to frequent modeling errors. Yeah, there is this thing called checks and flags. So these are things that we can use it a lot, but I call it like the check really. And then my checks tend to be like, we need to either get you on okay if it is like an error, so no error, or if it is like a one minus the other, so total assets equal total liability. To be honest, I wouldn't do this. I would just do total assets minus total liabilities, and then making sure that this is like a zero sum, because the problem with total assets and total liabilities, if there is like a rounding error, then this is going to be a false statement in your Excel, and you'll be like, oh, where's the error? Where's the error? Where's the error? And that might be like 0.0000. And you're like, okay, I've spent the whole afternoon, days trying to get you an okay answer here, or like correct answer here, and then actually it's just a rounding error that I could have well lived by. So make sure that you understand that this is the main the structure of your financial models is also to make you quicker and not spending time with rounding errors. Okay, so let me just see. I have 13 minutes. So what I want to do here now is I want to show you, because I like to show you some things. Yeah, we're almost there. How to do this scenario analysis. Okay. So I'm just really gonna show you because we don't have much time. So I'll show you how my steps, and then hopefully you can practice at home as well. So the thing here is that, let me see if I'm so I have here a model, a teaching model here, which is the value add model. Okay. And then here we're going to have the returns. Okay. So we're going to have here an IRR. So this is a typical, like a value add model that you have like one asset, and then there's some tenants there, and then you're gonna receive some rents, and then there's gonna be a big refurbishment, and then you're gonna increase your ERV. So yeah, so that's the scenario here. Just want to explain, and then we're going to say, okay, if you're doing the sensitivity analysis, and then you're going to say, okay, if you're doing this kind of development, so like if there is one thing that is really going to make or break your investment, is how much you're going to actually sell for, or like what is the added capital value, that the value add that we call like the added capital value on this building. And this is pretty much stressed by the exit yield, or like what is going to be the gross development value of this building. So if you stress that, that's one that will have the most impact. So that will be one that we're going to say, okay, I'm going to use a data table, and then just stress by 25 basis points my exit yield. So my base case here is 525, and then what happened? Normally, we are interested in the downside risk. So I normally stress more on the on the negative side, which in our case would be like the increasing or expanding um, um, yields. Okay, and then the other thing is there is the scenario analysis. This scenario analysis, I'm going to show you how I've done here, is because where with the Excel, you can stress either one variable or you can stress the maximum two variables. Okay. And then it's easy. Like you just stress, exit yield, construction cost, or something like this, or exit yield and construction duration and see how it goes. So you can always stress like in pairs, or you can stress just one. Normally with the exit yield, I want to stress just one because that's where most of our return will come from, really from the GDV. So here, what I want to do now is not stress one or two, but more variables. Okay. And that's when really I have to think about this investment because we're going to say, okay, there's not only, especially in development and refurbishment, in this huge kind of refurbishments that this case study is about. So we need to think about like what happens if there's different scenarios. Okay, so we need to think about and design those scenarios. How we design those scenarios. So here I designed just three scenarios. Okay, good, neutral, and bad. But you could design like many more, like hundreds, and then at the limits, if like at the limit, infinite scenarios as well, which is like the randomization. But that's not the point. We want to still control like what are the scenarios that we can think about here. So here I just put three, okay, and then a positive one, neutral, which is our base case, and a bad one, and then I will say, okay, so then I have to think about, okay, what about the good scenario? What I think is going to be my exit yield like? Is it going to be, there's going to be a yield compression -1%, or is it going to be, the bestest of scenarios still going to be 0.5% reduction in the yield because, that's how I see it happening because the yield is a relationship um, between the required returns and growth and so on. So it might be that you think that the maximum is going to be 0.5, which is absolutely fine. They don't necessarily need to be symmetric. Okay. This is your analytical decision. It's not because I put here -1%, 0 +1%. There's no, it's the symmetry will pretty much depend on what is your idea of good, neutral, and bad. The rent as well. So what happens if your ERV you estimate here, like £90 per square foot or $90 per square foot or 900 per square meter, whatever it is. What happens if I got it wrong and actually it is 10% higher, 10% more? So instead of 90 is 99, because my estimate is wrong. Not because I didn't check the comparable, but it might be that my comparable on the ERV, it's a little bit, I was too conservative, and then actually I should have used a different comparison. So that's pretty much like um, uh, ERV error, so to say, rather than ERV growth, because I also want to test here the rental growth. Okay, so what happens if my rental growth? So I'm gonna take, more stronger rental growth and not, and then also construction costs. What happens if I manage to, decrease, like the 10% is my contingency. What happens if I don't use my contingency, for example? And then the construction durations, what happens if I finish early? I wish. But these are scenarios that you can put like variables that you can stress, okay? And then and this is your analytical decision, okay? So this is where you become an analyst because you have to think about the future and you have to think about what is the what are the main stressing points for the future that will make or break your investment, okay? So all too well. So yeah, this is the hardest, like this is the hard way to think about it. I think this is the 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 area that you have to think about because now everything else is kind of the mechanics of how we're gonna put those numbers that you thought about into what we call, KPI. So is it going to be, what is going to be your IRR? What is going to be your NPV? What is going to be your equity multiple, given what you thought about the future? Okay, so the mechanics is that's what I want to show you. So first off, we need to, here, this is your scenarios. Yeah, we have only 3, and these are your variables. And then we need to create here what we call an active scenario. Okay, an active scenario. So here is just saying, okay, the active scenario, I put a drop down menu here, and this drop down menu comes from data validation. So if you are not familiar, it comes from data, and then there's here data validation in this data tools here, data validation, and then here you're gonna put the list. Okay, so that's the mechanics of it. So just so you have a drop down here. So the data validation is good because it constrains. Because if you're going to say, I want scenario 4 there, then you're going to say, okay, scenario 4 doesn't exist. So Excel itself is going to tell you that this doesn't exist, and it's going to force you to put the right number. Okay, so this is the active scenario. And then what happens is that you have to link those scenarios with what we call the active scenario. So the only way to do it is going to say, okay, so this is number 2. So if this number 2, we're going to index match here with the number 2. Okay, so if it's number 2, it's going to be neutral. If it's number 1, it's going to be good. If it's number 3, it's going to be bad. And then this is going to be across the board. So if this is true, then it's going to be the neutral. If it is number 1, then it's going to be good. And then all your scenarios here, all the variables here will be impacted by the good scenario. So it's like a changing your inputs, changing your exit yields here. It looks like 5.25, but actually the calculations are being done with 1% less, which is 4.25. Okay, so this is the main thing. And then what you need to do here is, I've done this, but this takes a little bit of time if you're doing, but you need to connect this with your calculations. Okay, so not the precedence, but the dependence. I'll just go here. So trace dependence. So I'm just linking here the minus 1% with your exit value, with your GDV, yeah, and then just saying, okay, here's it looks like I'm calculating on 5.25, but actually this variable here is being calculated on 4.25 because I'm reducing by 1 the yields. Okay, so you have to connect everything. So trace dependence as well. So the 10% of rent is going to impact your ERV calculation and also on. So this is how you need to link those variables with your actual calculations. Okay. Then what is the next step? The next step, once you've linked, so this is the part that takes a little bit of time because you need to make sure that everything is linked. So instead of showing like your growth will have to be calculated with the growth of the scenario. And then once that is done, then what you can do here is then you can use a data table. Okay, so once you've done that, you're gonna do here, you're gonna link your data table. So you're gonna say, okay, I want the description, the geared IRR, gear NPV, and the equity multiple. So you want on the equity basis. Gearing means like a leverage on the equity basis. Then you're going to run the data table. So to run the data table, go data, what if analysis, data table. And then what's going to happen here is that you're going to say, okay, your scenario here, the column input cells refer to your active input cell here. And then you can calculate here because everything is connecting. Yeah, then it means that this returns here. So on your good scenario, your IRR, your equity IRR is going to be 37%. Your NPV is 202 million, and your equity multiple is 6.5 times. And then in your base case, your IRR is 16%, your NPV is 10 million, and you're going to run at a 2.8 times. And then in the bad scenario, you have a negative IRR and negative NPV, and then you're not even going to recover your money because your multiple is less than 1. Okay, so you can stress those variables, and then you can also think about weights for each scenario, and then you can create like a weighted, risk-weighted returns, which then you'll be okay. So my base case is 16.25, but weighting by what I think the scenarios might be is 16.1%. And then in your base case, your NPV is 9 million. But then if you weigh it by the scenarios, then it's going to be 15 million and so on and so forth. Okay, so that's also a way for you to risk adjust your returns, okay, using the scenario simulation here. Okay. And then I think that's what I want to tell you. One thing that is very important that I want to show is because once you start running the scenarios, because everything is linked to your inputs, if you leave this as one, it means that all your calculations here are going to be based on the good scenario. Okay. And this is very dangerous because if it looks like you're calculating your GDV here based on the 5.25, but actually you're calculating your GDV here based on the 425, and then all your returns are going to be wrong. Okay. So the only way to show the correct, like your inputs, is if you revert this to the neutral scenario, your base case. Okay. So one thing I've done as well is if it is number one, like for example, it's not your base case scenario, all your calculations are not reflecting the inputs that you put, but the inputs from the scenario. What happens as well is that I color code my inputs, so then I know that it's wrong. I'm calculating here based actually on the scenario that shouldn't be there. It should be the other scenario. Okay, so if you change this here to your base case, then okay, like phew, yeah, that's great. Like our calculations are in line with what we expect it to be given the inputs. Okay, so this is also one thing I would like to alert you, because I've seen it happening that all the KPIs here were being calculated using the goods variables, and then it was overestimating the base case. So at the end, it wasn't, it was something that we need to pay attention to, because otherwise you're going to give the wrong recommendation. Okay, so this is what I want to show you today in terms of the mechanics of Excel for scenario analysis. Okay, and I'd like to thank you very much for being here. I hope you enjoyed it. If you have any questions, please let us know. I'm sure you have our contact details through the email that we sent to you with the confirmation of this webinar. And I hope I'll see you all very soon. Thank you very much.